my YouTube channel, The Trading Line. This series of videos are specially created to discuss about the option selling strategy. In this video, we are going to see an option selling strategy which is mostly used when the market is sideways. When you think a stock or an index is going to stay sideways or within a range, then you can use this strategy. Let's see how to apply this strategy and what is the reason behind it and how the payoff graph of this strategy will look like. So the underlying index which we are going to take for this strategy is Nifty 50. The strategy which we are going to discuss today is short straddle. So please watch this video from the start to end so you won't miss any important points. So in short straddle, what you have to do is you have to sell at the money, call option and put option. So let's see that in the definition.com. So how to choose the strike price and how to implement the strategy. So everything we will see in this definition website. So in short straddle, what you have to do is you have to sell at the money call option and at the money put option. So now the Nifty is trading around 18,490. So I'm going to consider 18,500 as a at the money strike price. So this is at the money strike price 18,500. So you are going to sell a call option and put option. So once you implement the strategy, so this is how your payoff graph will look like. So here you clearly see that you have two break evens unless compared to the bullish and bearish strategy. So when the market is going to stay within this break even range, so your upper break even is 18,904 and the lower break even is 18,096. If the market is going to stay between these levels on the expiry, then you are going to make some profit. Your maximum profit will be at the money strike price. So wherever you are going to sell the call option and put option at that strike price only, you will be able to collect the maximum profit. But the probability of collecting the maximum profit is very less, but the probability of success of this strategy is very high. That too, when you are going to use this on intraday, that is very profitable as per the backtesting results. So the margin requirement for this strategy is around 1,27,000. So you have to keep at least 1,50,000 in your account so that you won't get into any trouble if the market moves higher or down. So this type of strategy is very risky because here you clearly see that you have unlimited risk if the market is move beyond this level, your lower break even 18,096, or else if it is move above this level of your upper break even, that is 18,904. But however, the Nifty historically move within 500 or 1000 points in a month. So based on some adjustments, we can able to get out of the trade with a minimum loss or minimum profit. So those adjustments we will see in the upcoming videos. And before that, I just want to explain you how you are going to implement this strategy in stocks also. So when it comes to stocks, mostly what you have to do is you have to select high beta stocks. So beta is nothing but the option Greek. So those things and all we will discuss in separate video. So why you have to choose a high beta stock in the sense, in high beta stock the implied volatility will be very high. So when the IV is very high, the premium tend to be maximum, so that the range which you are going to cover by using this strategy is very high. So that's why you have to always implement short straddle or neutral strategy with high beta stocks or high beta index. So when compared to Nifty and Bank Nifty is having high implied volatility. So you can use these strategies in Bank Nifty. But just for the example, I am showing this here in the Nifty. So I hope you understand uh, this strategy. So let's see what is the benefit of this strategy. So most of the time what will happen is the market is going to stay between this. So in case if you think the market may go up upper side, let's say now the spot price is 18,500. So what I'm going to do is I'm going to see the open interest for this month expiry. So I have chosen I have chosen this one, right? 29th December. So I'm going to see what is the open interest for that particular month. So go to open interest, choose the expiry. So Nifty, the expiry is 29th December. And here you clearly see that 19,000 call option is having more open interest. And here 18,500 and 18,000 is having more open interest. That means the market likely to stay between 18,000 to 19,000 for this month. So I can keep my straddle at 18,500. So obviously, you know very well what are the break evens we have, right? So again, I'm going to implement the same strategy. So 18,500 call option one lot sell, and 18,500 put option one lot sell. So now compare the open interest with the break even. So the market is likely to stay between 19,000 to 18,000. So here you can see we have just just 100 points hedge from uh, the open interest level to the break even level. So that is not going to be much risky to manage the position. So you can leave your position like this, and there are some adjustments you can do it. So this is how we have to take the trade based on the open interest. So in case if you find open interest is high at 19,000, let's say at the month starting you find the more call option and put option is written on 19,000, even if your uh, market spot price is 18,500, you can put a straddle at 19,000. Instead of keeping a straddle at the money, you can go some in the money options and you can sell the 19,000 short straddle, so that when the market moves to 19,000, your loss will be very less, and you have high probability of getting the profit. So I hope this video is very useful to you guys. In case if you want to discuss anything, leave that as comment, else contact us through our Telegram channel. Thank you.